Hello, everybody, and welcome to another podcast with Investing Education Academy. Today, we will be talking to you all about something that's very important. What companies will benefit from the upcoming rate drops? So, Leon's going to tell you why we chose that topic while I do a little bit of housekeeping.
Yeah, so last week or 2 weeks ago, we talked about the coming rate cuts, and how they're going to affect your credit, how they affect your credit cards, loans, any debt that you currently have, or may look to get in the future. We were saying how the coming rate cuts are going to affect that. Now, as we all know, rate cuts are a beautiful thing, because and we talked about last week. Some people's credit cards. I mean, mine in particular, my credit card rates are at or above 30%, 30, which is ridiculous. My credit score, I think I said it last on the last one, is it's like 680. But I've been working on it the last couple of years. I'm getting close to 700, which is great. But Brent mentioned that his is above 800, well above 800, and his rates are still relatively high too.
And a big piece of that is the fact that, I do a lot on credit, and Leon tends to do a lot with cash. And
Right.
so when you all hear that, and you're probably thinking like, "Oh, well, what does that mean?" It doesn't mean bad credit or something must have happened to his credit. It's just that for a long time he used cash.
Yep.
And those of you all who are those people, you know who you are right now. Like, yeah, I do too. And the thought is to hell with pretty much credit. I'm always going to use cash. Okay, I never will need credit. So why should I care what my credit score is? You should. But for this one, that's not what we're talking about this time. We're talking about the stocks that will benefit from this upcoming rate cut. So Leon, the
Yep.
floor is yours.
So I mean, so we've all been, we remember the last sets of people that have been following us since really 2000. And really, let's say 2022, rate increases. We remember they were doing 25%, 25 basis points, or a quarter of a percent, roughly every other month. The Federal Reserve was raising rates. Then they jumped to 75 basis points, which is 75 percent of 1%, almost 1%. And the rates just effectively went from at let's say your credit card at one time was your rate was like 11%. Over the last year and a half, that's almost doubled for some people, right? It's gone from like 11 and maybe the low 20s for some people in the mid teens, close to 30, like me. And it's just, it's been horrendous as far as trying to get loans or use leverage. But also there was a reason for that, right? Because inflation was raging, so we needed everyone to slow down on their spending to bring down inflation. Well, that's happened over the last year and a half, which is great. Inflation is close to the Fed's target of 2% annually. I think right now it's running at about 2.5. So the Fed said, hey, once we get close to that, the rate which we're targeting is 2%, we can then start to cut rates. Well, this week, or actually this month, let's say this month, September, they're going to do the first rate cut. Everyone's pretty much predicting is going to be 25 basis points, or a quarter of 1%. Doesn't sound like a lot, but this is now starting a rate cutting cycle. That's the real thing. Just like back in 2022, they started a rate raising cycle, which raised the cost of capital and choked off a lot of spending. This is supposed to do the exact opposite: lower the cost of capital and then slowly increase spending again, because the economy has definitely slowed, which the Fed wanted to slow inflation, but the Fed doesn't want to choke off the economy. So they're starting to cut rates, which is going to again make the cost of capital cheaper, which is going to spur. We're supposed to spur spending. We'll see what happens in the coming year and a half to 2 years by the time they finish this cycle. Now, as you said, we're here to cover what stocks will benefit from this, right? Well, the one I think everyone can relate to are mortgage company stocks and home builder stocks. There are way more home builder stocks than mortgage company stocks. There are mortgage company stocks out here, but the home builders are the big one that everyone's really looking at as a place to go. Now, if you look up any home builder stock, you'll see over the last year and a half, these things have been running like tech stocks. Some of them look like Nvidia, like the way their chart just goes from bottom left, upper right, straight up. Reason is that the Fed has been telegraphing, the environment in which they would actually start cutting rates. So of course, the market is always a forward-looking indicator. So it knew these rate cuts were coming. Didn't know exactly when, but it knew they were going to come probably sometime this year. So what happened was the market front ran that, right? So people started buying up these home builder stocks 6 months, 8 months ago. and have enjoyed, 20, 30, 40, 50% gains over the last, like I said, year and a half. That doesn't mean it's over. It just means that for that first cycle of the first wave of those stocks going up might be over, because right now the market's in a pullback and everything is pulled back anywhere from 5 to 20% depending on the stock. But just know that home builders and mortgage stocks are one of the main industries and stocks that will benefit from a cut in rates. Another one is car companies, right? Or car companies and or dealership companies. So when I think of, and I still can't believe these companies around, because they literally almost went to zero like a year and a half ago. Carvana. If you look at Carvana, that thing looks like another Nvidia. I mean, I think the stock got down to under $5, and I think now it's above, I don't know, 100 and something. Like it was crazy. That had nothing to do with the rate cuts. They had their whole different financial situation. But Carvana, is a seller of cars. The way most people buy cars is via loans, right? And with rates coming down, cars are going to become easier to access than they've been in the past. And one car company in particular that Brent and I aren't really big fans of recently or lately, Tesla. Right, Elon Musk has said, and he's actually blamed the government, blame the government for this. He's saying the reason that Tesla, the stock, has been hit so bad is because rates are high. He's not exactly wrong. I mean, the high rates.
There are things other than
exactly. There are way more reasons why Tesla stock has been punished the last year and a half, but high rates is one of them, right? Because again, 99% of people buy a car through a loan. He's saying, look, with rates so high, it's hard for people to buy my cars, which is a fact. But again, there are a whole host of reasons why Tesla's down. But say that to say, you want to also look at car companies: Tesla, Ford, Toyota, Stellantis. There are even some overseas ADRs you can buy for car companies. Another one that's going to
okay. Before we go too far, I know Leon slid that ADRs thing in real easy, so I'll make sure if you're listening, ADR is what's called an American Depository Receipt. And while he said overseas and then he said ADRs, you might be thinking that's the ticker symbol you're looking for. It is not. It is a type of stock that sells. It's an international stock that sells in the United States under basically a cloak that's very similar to a domestic stock. So when you're buying it, you really wouldn't know it was a ADR or American Depository Receipt unless you looked up the type of stock that it is. So just for those of you all who heard that and thought, what is it? And the reason the government does that is there are a lot of companies, foreign companies that people want to invest in, and those companies want to trade on our stock exchanges, but they have to meet certain regulations. And through the process of becoming an American Depository Receipt, they've met the guidelines that says, the U.S. citizens can actually invest in these companies through our governed indices or stock platforms, but they've already met requirements to make them not safe, but more likely to be viable companies.
Right. It's almost like they've been somewhat vetted by the U.S.
Yeah, I was trying to avoid. I was like, should I say it that way? Okay.
Yeah, they've basically been kind of vetted by the U.S. financial system, more or less. So an example of an ADR, and again, none of this is financial advice. We're just giving some examples. One of the ADRs is a company overseas in China, I believe it's the largest electric vehicle company in China, called BYD. Warren Buffett used to own a large portion of this company. The ticker symbol, the ticker symbol for the ADR, as Brent just explained, is BYDIY. And again, that's an ADR. And again, you just buy like a stock. I mean, there's no really even reason to know about ADR. You just buy like any stock. Yeah. But just know that these companies are typically based overseas, and they're foreign companies. So, and one thing I just want to give also was I brought up Carvana before. So, Carvana, back in the beginning of 2023, the stock got down to $3.55. Because like I said, it was literally on its way to zero, all the problems it had. The stock closed Friday at $141. So you're talking, you're talking in almost less than 2 years. This thing has, I don't know what percentage gain that is. 355 at the low. It closed Friday at $141. Now, I'm not saying that's based on the interest rates, because like I said, there are a whole host of other reasons why Carvana almost failed and then came back. But going forward now, it's a company that you may want to look at, because again, it's a company that sells cars, and cars are bought 99% via loans, which is the interest rates on loans are going to be going down. So that's going to be good for car companies.
Let me just jump in for a second.
Mm-hmm.
So if a person would have taken I did this calculation just now. So if a person would have took $1,000 at $3 a share, you roughly would have got like 33 shares. Those shares now will be worth $46,666. Let me make sure I did my math correctly.
46.
So 1,000 divided by 3. I'm sorry, I was off. It would give you 333 shares. So it would have gave you 333 shares, and you multiply that times, let's just say 140 for ease, which is roughly the current stock price. And that gives you $46,666.66.
And I just did the math. I just did the math on the percentage. It's 4,600% gain.
That's right. Because I got it's 46,666.
Yeah, right.
So that will match your rate.
4,600% return. And again, we're not trumpeting Carvana.
This is me and Leon geeking out on stocks.
Yeah, like, we did. We just looked this up and we're like, wow. But using Carvana as an example of a car company, car dealership that you could look at, because again, cars are bought by your loans. The loan interest rates are going to be going down. Two more you want to look at also are construction companies, because again, so companies like Caterpillar, Deere, things like that. Because again, these companies, when these companies' products are used, a lot of times they're leased and or bought on loans, right? So again, loan rates are going down. These things would be more attractive to companies. One more is also defense companies. Defense companies build, as we know, satellites, drones, missiles, things like that. Again, a lot of these things are bought via loans. A lot of the parts for these things are bought via loans. So this could help improve the profit margins of these companies. So the big ones we talked about to look at that could benefit from falling interest rates are home builders, mortgage companies, car companies, that's cars, the actual builders of cars and dealerships, construction companies, and also defense companies.
And if you're wondering why, is these companies buy huge amounts of products. If you're buying goods, most large companies leverage credit. It's just the way it works. I know you're thinking, oh, well, they're large companies, maybe they pay for everything in cash. They do not. Additionally, that means who's ever making the parts, the raw goods they need to make the parts to sell to these big companies become cheaper for them to acquire the parts as well. And in some cases, they spread that discount to the consumers, which would be large industrials at this point, buying, megatons of wood, to build homes. If Caterpillar is building these machines, somebody's building the wheels for all these Caterpillar, cranes and, heavy lifting equipment, this excavating type of equipment. I mean, you're talking about mining is really big right now. So they're buying very large machinery, specialized equipment, and they're using leverage money, which means they're using bank money. They're using, sometimes it may be coming from investors, but we're talking about bank money right now, right? It's leverage money. The cheaper that is, the more they are willing to buy other things with the money. The more they're willing to buy. Also, too, they'll pass that savings on to the end consumer, which is car companies, might be us.
Mm-hmm.
So you might see a drop in car prices because it's cheaper for them to get parts. It's cheaper for them to do the manufacturing needed or to build a manufacturing plant closer to where they sell the majority of their cars. So the travel distance between it's a waterfall effect.
Mm-hmm.
And just understand is when you're hearing us say this, you're probably thinking, well, okay, but how does that actually help them? Why does interest rate matter? How does it help? This is what we're telling you now. The part people who make those widgets, they're making it cheaper. They're probably selling it to the companies cheaper because money for them is cheaper. Since money is now cheaper, they can buy more of the product, or maybe they can just lower the price. When we walk in the door as consumers and we're trying to buy that thing, we're also walking in with leverage money a lot of times. We're going to our banks. We're saying, can we get a loan? And we're more willing to get a loan now because it's cheaper money.
Mm-hmm.
And I hope that makes sense to you all. So now we're getting cheaper money to buy the thing that should cost less because the manufacturer got the parts for less and it cost them less. And now everything's less.
Mm-hmm.
So this big waterfall effect is how it plays into us. And when what Leon and I are talking about is you should know what companies are positioned to actually take advantage of these lower rates because they could be really good investment opportunities for you all. And just think about these companies about lots and lots of materials. Those companies are slated possibly more than likely to have reduced costs and or to lower the price to the end consumer, which should drive their interest in their stock up, which will benefit you in the long run if you invest.
Yeah, it could ultimately be deflationary, right? We've been dealing with inflation the last 2 years. Lowering interest rates could, and we're always saying could because
You never know.
companies, yeah, companies, a lot of times companies may or may not, like Brent said, pass that savings on to us. I think with a lot of political pressure that's going on right now, I think we will start to see things come down in prices because of, again, it's election year politics. But it's just good business, right? You don't need to charge your company so much money if you can keep the same profit margins at a lower price. It's good. It's good for you. It's good for your, I guess, your PR for towards your customers, and it encourages your customers to buy more of your goods. So this whole rate cutting cycle we're about to go on is going to work its way through the supply chain of everything. Like I said, now we're not saying we're going to see dramatic lower prices, maybe not even anytime soon, but over time we will see lower to some extent. But if we don't see lower, right? But if we don't see lower prices, what's good for us is that the loans we go to get to buy some of these goods, the payments are going to be lower for us because rates are going down. So either way, we're going to benefit. We just hope that these companies do pass on their lower cost of capital to us. Will that happen? We don't know. We hope so. But either way, we're going to benefit from lower rates because our loan payments are going to be less.
Yep. So everybody knows we owe you all two things now. It's our stock picks. You can actually log into IEAmembers.com to see what those two picks are. If you are not a member of IEA, we highly suggest you become a member. We have plans. If you go to IEAmembers.com, you can see our plans. There's pretty much something for everybody. The novice just starting out and the person who's saying, you know what, I want to invest with you and Leon. This is something for everybody. So again, thank you for listening. Our listenership on our podcast is growing. Please continue to tell your friends about this podcast. Share it with them. And anybody who wants to go direct, you can go to IEA Podcast, that's plural.com, IEApodcast.com, and subscribe. We look forward to seeing your subscription hit, and you can also visit us on YouTube. Everybody, thank you for being with us. We'll see you in 2 weeks.